Welcome to the inside of my brand new Tesla. And yes, I was able to fit my desk, mic, and computer in here. And we are here because all I've been hearing about is TSLY. So I've finally decided to do a deeper dive on this covered call ETF and see if it is worth trying to get the current 49.1% APY. Yes, you heard that right at the time of this recording. And as usual, none of this is financial advice. I'm not a financial advisor.
Knowledge.
Now, what is TSLY? This is a covered call ETF that focuses on selling covered calls on Tesla, but it doesn't actually own the stock. It uses a thing called a synthetic covered call, which means you buy a call 6 months out, in their case, sell a put at the same strike, and then sell a covered call since you own the call. Doing this combo basically tracks the stock price 1-to-1 with much less capital involved, and now you can sell calls on the stock. They're attempting to sell covered calls 5 to 15% above the current price of the stock to collect the yield. And then the money they get from these calls, they pay out as a dividend. Was that a little confusing? Yes, that's a lot of options trading. You'll have to do a little bit more research to understand the synthetic covered call. If you want more information about their fund and their documentation, I put it in the description below. So with these covered calls, this is how they're paying the dividend. And the dividend is paid out monthly. And so far, it's been pretty volatile. 1 month, you might see $1 per share. Later in the year, you might see 44 cents per share. Which is still very impressive for the fund, don't get me wrong. So this isn't really something you should be purchasing if you want consistent income monthly. This is not one of those ETFs, but if you're chasing a high yield, it's doing pretty good. With the ETF too, you may be thinking the price of TSLY doesn't matter if you still get paid a dividend. But I'll let a portfolio manager from YieldMax, Jay Pestrelli, answer this one.
Great answer. So next statement. The price of TSLY doesn't matter because the dividends are so huge.
No, it definitely matters, right? So if I was to think of the two components that were important to the dividend, it's the volatility of Tesla. That is number one, probably number 1, 2, and 3. And then number 4 would be the price of Tesla itself.
So Tesla's stock price does matter and the dividend payment would be affected. Jay also said during this interview, the fund is actively managed and they're actively trading in this fund. So when you're owning this fund, you're also putting your trust in their portfolio managers to trade and roll their positions correctly. So this isn't just like some automated robot. There are people actively trading this fund. And this would explain, in their case, the 0.99% expense ratio, which is the highest I've seen of these covered call ETFs. But, you're also getting an insane yield, so I don't know if it really matters that much. And someone is actually trading for you in this ETF. I also put the full interview from the channel Armchair Income in the description, which I think is a must watch if you're seriously considering this ETF. So what are some reasons not to own this stock? We get an incredible dividend yield. You're owning a lot of Tesla. Some people are really bullish on Tesla. I think one of the main examples we need to look at is QYLD, which is a covered call ETF everyone was excited about a year or two ago. Now, with the covered call ETFs, the thing is you're limiting your upside because you're selling a call. So if the price strikes up higher, you're limited by that call, and then you have to roll it and keep rolling it. So with the covered call ETF, the natural tendency is down, which we can see in QYLD. Despite SPY, and QYLD started in 2014, despite SPY in 2014, let's go over here, being up, let's see how many percentage points. Being up about 141% since 2014, QYLD, without dividends reinvested, has lost more than 30%. And this is because with a covered call ETF, since you're limiting the upside, you're not also limiting the downside though. And I expect TSLY to do the same, and we can actually compare it and see it is doing the same. So let's define a big Tesla drop. Let's say the one from July 23rd, okay? Tesla dropped about 27%. TSLY, July 23rd. There we go. TSLY dropped about 27. Let's get it on. There we go. About 27%. So it dropped the same amount. And you can see this is at an all-time low, basically. This has not recovered like Tesla, despite Tesla still being up from the bottom in January. TSLY still at the bottom in January. These funds just slowly lose their price over time and just slowly dwindle down. And as we heard in the interview, the price does matter. And the price of this is just going to keep dwindling down because the upside is always limited with the covered call and the downside is not limited. It's the same with QYLD. TSLY is going to be the same as that. The all-time high for TSLY was probably when it first launched at about $21. The upside is always limited and the downside is not. If we look at the upside of TSLY, let's go from January, when Tesla had a great run, to the peak, okay? January low, let's just start at the bottom of this candle, to its highest was 185% gain, just about. TSLY, let's see what we got, was a 38% gain. Now, if you were reinvesting the dividends this whole time, yes, you're probably doing pretty well, but it's still not 185% gain. If you're taking out these dividends, that's really not going that well for you. Let's say you had some bank in the beginning of January and put in $50K in a Tesla and TSLY, and this is reinvesting the dividends. Tesla is still smoking TSLY. Tesla right now, if you put in that 50 grand at the beginning of the year, you'd have $104,000. TSLY, with everything reinvested, you're at 76. So if you're bullish on Tesla, it doesn't even make sense. And then let's say you're actually withdrawing these dividends to pay for something. So let's remove reinvest dividends. No, let's analyze. TSLY's a sad little portfolio. You're back, you're under $50,000 now, and Tesla's just absolutely smoking it. So this isn't really a good deal if you're ultra bullish on Tesla. It doesn't make sense to only own TSLY because you're limiting your upside if you're that bullish on Tesla. Let's say you drop 50K at the beginning of the year. You're still doing quite well on TSLY if you get back out the beginning of January. But just holding Tesla did better, even with dividends reinvested. If you think Tesla is way overvalued and going to nuke sometime, it doesn't make sense to hold TSLY either, since most of their ETF is literally Tesla and then just some US securities and cash. But if you're neither super bullish or bearish and feel Tesla may just chop around this year, I think this would be a great ETF. No nukes, no extreme downsides, no super bullish runs. You're not missing out on the upside, and then your downside's limited. But really good luck on guessing how Tesla would react. So if I was actually going to play TSLY, and I might, it just seems kind of fun, it's a little crazy, I'm going to target to purchase TSLY when Tesla drops dramatically, let's say like 20% or so, which happens more often than you think, and you get a good buy-in price for when the stock slowly drops down over time like QYLD did. We can see if you use that plan, just buying when it dropped about 20%. This is January. Let's see how many opportunities we would have this year. 1, right here, from February to March, that's a 20% drop. 2, right here, that's from March to April. Let's go over here. 20% drop. Yep, and you get a buy again. And then you're probably going to also get to buy again over here if this comes down. So far you had 1, 2, 3, and maybe 4 buying opportunities. And that'd be really quite good. You would have bought 20%, about 20%, and then about 20%, and maybe 20% again. So you'd be doing much better than buying when Tesla's pumping and pumping. If Tesla just really is up and down, I don't understand why you're buying at all-time highs. Wait for a 20% drawback throughout the year. Be patient. It's already happened 3 times. It might happen a 4th again coming really soon. But of course, all this just depends on your own risk tolerance. These are really just my thoughts, not financial advice. Currently, I do have the risk tolerance for this, but that's why I'm buying Bitcoin instead and waiting till 2024, hoping for a bull run instead of focusing on TSLY. And you can check out why I'm doing that right here. Peace.